The board is very conscious that monetary policy operates with a lag and that the full effects of the tightening to date have not yet been felt. It takes time for businesses and households to adjust their spending and investment, and there are significant resets of low fixed rate loans to come. Given the lags, economic growth is expected to be subdued over the next couple of years, and it will take time for inflation to return to target. It remains to be determined whether monetary policy has more work to do. It's possible that some further tightening will be required to return inflation to target within a reasonable time frame. Whether or not that's required will depend upon how the economy and inflation evolve. At its next meeting, the board will have an updated set of economic forecasts from the staff, as well as a revised assessment of the balance of risks. The board will also have new readings on inflation, the global economy, the labour market and household spending to help inform its decision. Our priority remains to ensure that this period of high inflation is only temporary. High inflation hurts all Australians and it damages the functioning of our economy. It erodes the value of people's savings. It makes it harder for businesses to plan and it makes it harder for them to invest, and inflation worsens income inequality. And if high inflation were to become entrenched in people's expectations, it would be very costly to reduce later, involving even higher interest rates and a larger rise in unemployment. That's the reality we face. It's for these reasons that the board is resolute in its determination to return inflation to target within a reasonable time frame, and we will do what's necessary to achieve that. Our most recent set of forecasts, which were prepared in early May, have inflation returning to the top of the target band in mid-2025. Data received since then have suggested that the inflation risks have shifted somewhat to the upside, and the board responded to the shift in risk with a further lift in interest rates. We're continuing to assess the central forecasts and the risks, and we will conduct a full review of the forecasts and the risks at our meeting in early August. As part of that review, we'll be assessing the many cross-currents affecting the inflation outlook at the moment. On the one hand, there are ongoing pricing pressures from a number of factors, including the very high level of capacity utilisation in the economy, quite strong growth in unit labour costs, mainly because of weak productivity growth, a big pickup in rents, and higher prices of electricity. But on the other hand, there are factors working in the other direction contributing to an easing of inflation. These include an easing of the COVID supply chain disruptions, a decline in commodity prices in global markets, and slow growth in aggregate demand, particularly in household consumption. The slow growth in demand is expected to lead to some rise in unemployment and a moderation of growth in unit labour costs. It's also expected to reduce cost pressures on firms and to lead to greater discounting than has been the case over recent times, and this should help bring inflation down. So it's a complex picture at the moment, and there are significant uncertainties regarding the outlook. The board decided that having increased interest rates substantially, it was appropriate to hold interest rates steady this month and then to re-examine the situation next month. So thank you very much for listening, and Michael, I'm looking forward to the questions. Thank you.